Okay, in this series of videos, we're going to look over accruals and deferred taxes. Again, by way of background, as we prepare to get into the meat of the course, we're going to be reviewing these ideas from accounting and seeing how things affect cash flows from a finance perspective. So let's get started here. So accrual accounting comes from generally accepted accounting principles, or GAAP accounting. And the notion is that the accounting will reflect economic events and economic reality, but not necessarily cash and cash changing hands. From a finance perspective, we care about tracking and projecting cash flows. So we have to kind of keep in mind this balancing act between GAAP accounting and finance. And then for lending and investing decisions, we need to understand the prospective cash flows of the firm and be able to project those and estimate the future cash flows that are going to arise from running the business. Here are a few examples of accruals. Buying or selling on credit. This is where you don't pay cash right away and you're not receiving cash right away, but you've sold or bought something. So you owe it later or you're going to receive it later, but no cash is trading hands today. Another example would be paying workers monthly for their labor. You're getting the benefits of the labor over time, but you're not paying for it until at the end of the month. Depreciating an asset is another example where there's no cash changing hands, but you're recognizing an expense. Selling goods where the customer hasn't taken delivery. There, some cash may have changed hands, but we've got an accrual going on. Reporting taxes via GAAP, but we may be paying something very different to the IRS. We're going to talk about deferred taxes later on. Receiving partial payment on a long-term job would be an example of an accrual, and then also completing a part of a long-term job but having not received any payments yet. All of these are examples of where accruals would arise, and the accounting entries may not necessarily reflect the cash trading hands. Okay, so let's look at a few accounts, and in particular start with some asset accounts and talk about accruals and where they show up frequently. Accounts receivable is a very common one, and those arise from accrual accounting, and it's an example of a sale being made but where no cash is being received. So you've distributed some goods, you've sold those goods, and you've taken an IOU. So no cash is happening, but you're going to recognize revenue, you're going to recognize the sale, and create some accrual accounting entries. In addition, the book value of fixed assets, that's going to reflect a depreciation expense being recognized, and that may or may not reflect the economic value of the asset, but again, no cash is changing hands here. We're just using this accounting construct of the depreciation to reflect economic reality. Now I say economic reality, sometimes that reality is different from or diverges from the accounting. And in particular, if I think of the field of real estate typically is going up in value, even though from an accounting standpoint, real estate is depreciated over time. So we can have this strange circumstance where depreciation has reduced the book value of real estate substantially, but if it's ever sold, there's going to be a humongous gain recognized at the time of the sale. Let's look at some liability accounts as well. Accruals, so if there's wages unpaid, you've incurred the expense but not yet paid it, that's going to be an example of an accrual hitting the liability side of things. Taxes payable are transactions that have created a taxable event, but those taxes have not been paid yet in cash, so we've got, again, another accrual here. Deferred revenue, the sale has been made, but you can't recognize the revenue because no delivery has happened. And then finally, deferred taxes. Again, we're going to look at this, but it's basically a difference between GAAP accounting and the taxes that you pay the IRS. Okay, in the next several slides, we're going to look at some transaction examples. And we're going to do this to see what is going on when a business operates and see how the accounts are tied together. I'm not really interested in the debits and credit side of things, but I do want to kind of tie what's happening in the accounting world with what's happening in the business world, and I want to see how the income statement is tied to the balance sheet. So we want to work through some examples here and see how these things are related to each other. A couple of assumptions here. We're going to have a 25% tax rate, and then we're going to assume that taxes aren't paid until the quarter end, so that means that there's going to be some taxes payable occurring along the way. So in this first really simple example, we're just looking at a $1,000 utility bill that is being paid with cash. When I say cash, that could very well be a check. Most likely is a check that is written and sent by the firm. But let's think first about the income statement effects. First thing is there's going to be an expense. The expenses have increased by $1,000. That's likely going to show up in the cost of goods sold. And that also means that the pre-tax income is now $1,000 lower than it would have been. So we will have taxes being at 25% less, so 25% of the $1,000. Lower income means we're going to have lower taxes. Taxes are down by $250. And our net income is going to be the residual. It's going to be down by $750. So expenses are higher, taxes are lower, net income is lower because of that. Now on the balance sheet side of things, we're going to have $1,000 less cash because we've written that check to pay for our bill. And then so that's the asset side of things. To make things balance, we need to have this taxes payable decrease by $250. So it's going to be similar to the taxes expense. And then net income is going to flow through to retained earnings, and retained earnings will be down by $750 as well. So let's make a few observations and put down a few rules here. The first one is that the balance sheet is always going to have to balance. One thing to always keep in mind is that the assets always need to equal the liabilities plus the equity. Another way of saying that is the change in assets always need to equal the change in liabilities and the change in equity. So keep all these relationships in mind, and this is one of those most important things. When you receive or pay cash, the cash account will always change. And if you're not paying cash or receiving cash, then the cash account will not change. It won't be affected. Taxes are always going to flow through taxes payable, and then net income is going to flow through to retained earnings. So if we keep those four things in mind, any of these transactions you should be able to handle and work through. So let's move on to the second transaction. And in this example, we've got the same $1,000 utility bill, but now we're going to pay it 30 days from now. So we're not writing a check for it today, we're going to pay it later on. So the income statement effects are very similar, in fact the exact same as they were with paying it in cash. We're going to recognize the expense immediately, and those expenses are going to go up. The pre-tax income will be $1,000 lower. Our taxes, we're going to save 25% there, so our taxes will be lower by 25% or $250. Net income will be $750 lower. On the balance sheet side of things now, the cash is not affected. There's no change in the cash account. And so there's been no change on the asset side of things. But on the liabilities and equity side, we do have these changes. The accounts payable has increased. That's a liability going up. But on the flip side of things, and to keep everything in balance, the taxes payable, that's a liability account, has gone down by $250, and retained earnings and equity account has gone down by $750. So we have a $1,000 increase in current liabilities, a $250 decrease in long-term liabilities. Well, no, that would be a current liability as well. And then the equity would be down by $750. So that all nets out to zero. So we're still in balance. All right, so in this last transaction of this video, we'll pick up with more transactions in video 2, but we're going to look at here selling some goods for $1,000 where the inventory cost of those goods was $800. We were carrying it on our books at $800. So let's look at the income statement real quick. We've got revenue of $1,000. Our cost of goods sold has increased by $800, and so that implies a pre-tax income change of $200. It's gone up. So our taxes will be going up by 25% of that, or $50, and the resulting net income will increase by $150. On the balance sheet side of things, again, we've received the cash, $1,000 is the increase there. We've removed the inventory. So it's physically gone, and we're going to remove it from our statements here. So we're going to reduce the amount of inventory by $800 to reflect the cost of goods sold. Our taxes payable is going to increase, reflecting that tax expense up there. And then the retained earnings as well are going to be increasing by $150. So we're going to stop here, and we're going to pick up in the next video with looking at some more transactions, and we'll pick up here with transaction 4 in the next video. So I will see you then.